If you've ever heard people on the news talk about bond yields are rising or investors are buying treasuries and thought to yourself, what does that even mean? Well, you're not alone. Bonds sound complicated, but the basic idea is actually really simple. A bond is basically a loan. When you buy a bond, you are lending money to a government or company for a set amount of time in exchange for your interest payments. For example, if you buy a 10-year Treasury bond, you are basically loaning your money to the US government for 10 years. In return, the government pays you interest every year and then gives you your original money back at the end. That ending date is called maturity. So when people say a bond matures, it simply means the loan term has ended and the investor gets their original money back. And this is the part many people do not realize. Once you buy a bond, you do not have to constantly trade it or stare at the charts every day. You can simply hold it until maturity, collect the interest payments along the way, and then receive your original investment back at the end. Now let's talk about yields. The yield is basically the annual interest the bond pays to the bond holder, also known as the coupon rate. So let's say you buy a $1,000 Treasury bond paying a 4% yield. That means the government pays you about $40 per year. If you hold that bond for the full 10-year term, you would collect about $400 total in interest payments over those 10 years. Then at maturity, you also get your original $1,000 back. So in total, you would receive around $1,400. Your original $1,000 investment plus roughly $400 in interest payments. And the good news is you don't need thousands of dollars to start buying government bonds. Most US Treasuries can be purchased for about $100 through treasurydirect.gov. That includes Treasury bills, which are short-term bonds lasting under a year, Treasury notes, which could actually range from 2 to 10 years, and Treasury bonds, which are longer-term bonds that can last up to 30 years. Now, this is one reason why a lot of retirees will move part of their savings, 401ks, and investments into bonds as they prepare to leave the workforce, because bonds are often viewed as more stable and predictable than stocks. If someone is nearing retirement, they may care less about chasing huge gains and more about preserving their money while generating a steady income. For example, if someone had $100,000 in retirement savings invested into bonds paying around 4%, that could generate roughly $4,000 per year in interest income while still allowing them to eventually receive their principal back at maturity. And while $4,000 per year may not sound like a huge amount, imagine if someone had $1 million invested into bonds paying 4%. That could generate around $40,000 per year in interest income alone. If those bonds were held for 10 years, the person with $100,000 could collect roughly $40,000 in total interest and receive about $140,000 back at maturity, including their original principal. And the person with $1 million could collect roughly $400,000 in total interest and receive about $1.4 million back at maturity, including their original principal. And it's not just retirees who are buying bonds. Banks buy bonds, which is one of the ways banks are able to pay interest on savings accounts and money market funds. Pension funds buy bonds, insurance companies buy bonds, even stablecoin companies and crypto buy US Treasuries. Why? Because bonds are generally considered one of the safer, more stable places to store a large amount of money while still earning a return. For example, if a stablecoin company is holding $1 billion and earning 4% in treasuries, that could generate around $40 million per year in interest. That's one reason stablecoin issuers are able to match and preserve the value of user dollars at a 1-to-1 ratio, because those reserves are often backed by highly liquid assets like short-term US Treasuries. Now, bonds can be bought or sold before they mature, and this is where bond prices and yields start moving around. Some people may choose to sell their bonds early because they need cash for a major expense like buying a house, paying for college, covering medical bills, or making another large purchase. Others may sell because they found a better investment opportunity or simply because they want access to their money sooner instead of waiting years for the bond to mature. Let's say you own a bond paying 4% interest. If newer bonds later only pay 2%, your older bond becomes more valuable because it pays a better return. Investors may pay extra to buy your bond. But if newer bonds suddenly start paying 5%, your older 4% bond becomes less attractive because newer bonds now pay more interest. So if you wanted to sell your bond before maturity, you may have to lower the price to convince someone to buy it. But this is another thing people misunderstand. You do not have to sell your bond just because prices are moving up and down. If your plan was always to hold the bond until maturity, you can simply continue collecting the interest payments and eventually receive your original principal back at the end. That's why many long-term bond investors are less focused on temporary price swings unless they actually have to sell before it matures. And this matters because the bond market affects almost everything: mortgage rates, savings rates, business loans, government borrowing, and even the stock market. That's also why stocks can sometimes fall when bond yields suddenly spike higher. Investors may fear that people will sell stocks and move their money into bonds because the higher yields offer a safer and more attractive return. Bonds may not sound exciting, but they quietly play a massive role in how money moves through the economy. And once you understand bonds, it becomes much easier to understand mortgage rates, Federal Reserve decisions, and why the economy behaves the way it does. And before anyone asks, no, I did not become a bond trader overnight. And full disclosure, this is not personalized financial advice, but understanding bonds helps understand why mortgage rates move and why the housing market behaves the way it does. That's why I started this educational series to help break it all down in plain English instead of financial jargon. Next week, we'll talk about how the Federal Reserve controls interest rates and how that affects everything from savings accounts to home loans. And if you're interested in buying, selling homes or land in Raleigh, Durham, Wake, or Johnston County, visit pearltucker.com for additional educational resources on all things real estate. Thank you so much for watching. Have a nice day.